Paying taxes in America is the duty of every citizen, but the real wisdom lies in planning your taxes properly and saving as much as possible. Tax saving does not mean hiding money illegally, but making use of the paths provided by the government itself. In this chapter, we will learn how to reduce taxes through deductions, credits, and smart planning. First, let's understand the difference between deductions and credits. Deductions reduce your taxable income. For example, if you earn $70,000 and have $10,000 in deductions, you will only pay taxes on $60,000. On the other hand, credits directly reduce your tax bill. For example, if you owe $3,000 in taxes and you get a $1,000 credit, your tax drops immediately to $2,000. Now let's look at the major deductions. Home mortgage interest deduction. If you own a house and are paying mortgage interest, that amount can be deducted. This is especially beneficial for middle-class families. Student loan interest deduction. If you have taken a loan for education and are paying interest on it, this can also be deducted from your taxes. Medical and health expenses. If your medical expenses exceed a certain percentage of your income, those can also be included as deductions. Next comes retirement planning. Contributing to a 401k or IRA not only secures your future, but also saves you taxes. Whatever you contribute to a 401k is deducted from your income, and it is not taxed at that time. This means you save taxes today and your money grows until retirement. Now let's talk about tax credits. Earned income tax credit. This is the biggest benefit for lower income groups. The government directly reduces a portion of your tax. Child tax credit. If you have children, you receive a tax credit for each child. This is a huge support for families. Education credits, like the American Opportunity Credit and Lifetime Learning Credit, these can reduce your taxes for expenses on education or skill upgradation. Now let's move to smart planning hacks. Use a health savings account, or HSA. If you have a high deductible health plan, the money you put into an HSA is tax-free, the growth is tax-free, and withdrawals for medical expenses are also tax-free. This is called the triple tax advantage. Flexible spending account, or FSA, also allows you to save taxes for medical and childcare expenses. If you are self-employed, properly include your business expenses as deductions. This can include office space, internet, phone bills, travel, and even home office deductions if you work from home. Charitable donations are also a way to save taxes. Whatever donations you make to qualified nonprofit organizations can be included as deductions. Another smart method is tax loss harvesting. This means if you have an investment that is making a loss, you can sell it and use that loss to offset your capital gains. This reduces your net taxable amount. Finally, it is important to take the right steps at the right time. Tax saving is not something you do only at the end of the year. It depends on planning throughout the year. Keep a record of all expenses, store your documents carefully, and consult a tax professional when needed. Remember, tax saving means protecting your hard-earned money and using it for your future. Take advantage of the routes provided by the government. Smart planning, deductions, credits, and the right investments will help you save taxes legally.